I'm going to go ahead and get started. Thanks everybody for being here. Another virtual meeting. We definitely appreciate it. So today I'm obviously going to do what I always do, which is first talk about the US economy, some US data. Some new US data came out this morning, and I'll touch on that. I'm obviously going to talk about the New Mexico economy and a little bit on the metros and non-metro areas of the state. In addition to that, after my presentation, we have a guest speaker, and I'll have Rayanne at the end of my presentation introduce our guest speaker. I think it's going to be really interesting. Jorm Robs speak for us today. I read in the newspaper this week some interesting stuff about the chili industry, and so I think it'll be really kind of cool to hear from that perspective. So without further ado, I'm going to go ahead and get started. So starting off with the US review. So the national economy, some data from the last year. And much of this is the same as last time in terms of the historical data. I'll get to the newer data in the coming slides. But as you know, in 2020, the US economy lost 9.4 million jobs. Over the worst part of the Great Recession, sort of for context, over a 2-year period, the economy lost about 8.8 million jobs. Now with today's data that came out this morning, the economy is down compared to prior to the pandemic, less than 6 million jobs. So a pretty sizable recovery over the course of kind of the post job loss era of the early pandemic period. As you recall, we lost some 20-something million jobs in a 2-month period. So to only be down 6 million jobs, I think is a pretty decent testament to the strength of at least some elements of the economy, despite some weakness in other elements. Initial and continuing claims for unemployment are falling. Real GDP in 2020, as we all know, was down 3.5%. That was the first annual loss since 2009 and the worst loss since 1946. West Texas Intermediate price of crude, which of course we all follow, about $70 a barrel. It slipped in the last couple of days. It had peaked up to nearly $75 a barrel, but we've had a couple bad days. I think it was down to $67 or so a couple days ago. This morning I checked it, it was just below 69. I don't know if it's moved up anymore. Consumer sentiment has firmed compared to a year ago, sort of expected. The economy is in a better position now than it was 12 months ago, up about 10% from a year ago. Stock market still around record levels, at least the Dow Jones anyway. Manufacturing and non-manufacturing indices are continuing to expand. They've expanded in every month, kind of month over month since I think around April or May of last year. So we've had over a year of consecutive expansion. COVID-19 infections are again on the rise. I'll touch on this in a minute. Vaccines are obviously being distributed, but uptake is slowing. Some questions for the economy. The question that I get frequently is inflation a concern? And also, is there going to be an infrastructure deal that's actually agreed to by Congress and signed by the president? And obviously we don't know, but it seems like it's moving in that direction. Okay, so I'm going to show you some data that I look at. I kind of refresh this data every day. I'm just curious. This is from Worldometer, and it's daily cases in the US. As we know, back in the fall of last year, we saw a tremendous spike in daily new cases of COVID. We saw a decline, a bit of an increase around the spring, and now we're on a new sort of upward trajectory. This is different than what we were seeing when we presented 3 months ago, in that we were kind of in a downward trajectory, and now we are again on an upward trajectory. In fact, according to these data, and obviously different data sources are going to show you different numbers, but according to these data, yesterday was the highest number of daily new cases since early February. And so clearly that's a cause for concern in terms of the continued positive direction of the economy. And obviously, it's going to call into question some of the decisions that policymakers make going forward in terms of maybe going back to perhaps some of the masking requirements and limitations in terms of the number of individuals and establishments and the like. And so something obviously we keep an eye on. Real GDP growth, these data came out last week. So the new data is for the second quarter of 2021. I won't go through this slide in nitty gritty detail. The newest data, as I mentioned, is the second quarter. That's the second to last column. That's the growth rates. The very last column shows you the contribution. So how much each of these components added to that 6.5% in the most recent quarter. Basically, the name of the game here was consumption spending continued to be strong for a second consecutive quarter. The distribution of the elements that added or propped up consumption was different this time. It's really services and, to a lesser degree, durables. Obviously, non-durables pushed ahead as well. But in terms of really adding to the bottom line, services moved ahead. The 12% seasonally adjusted growth really moved things in a positive direction. Non-residential fixed investment also moved ahead, but the remainder of the components on net pulled things down. So residential fixed investment, government on net pulled things down a bit, net exports pulled things down, and changes to private inventories pulled things down. The one thing I'll note about this is that the 6.5% in the second quarter, although robust, is well below what analysts were expecting for the second quarter, even a month before these data came out. So you'll see, I'll show you on a slide, I'll highlight it in a bit, IHS Market, who, of course, as you all know, we get our national forecast from to push through our New Mexico model. They had expected as recently as early July that GDP would expand by about 8%. Through the course of the month, as more data was rolling in, they were kind of pulling back that expectation. But the data coming in at 6.5% is a bit of a disappointment, to say the least. So a little bit of cause for pause, I suppose. U.S. employment situation. So on this slide, I'm showing total employment, total non-farm employment, and also the unemployment rate. The numbers that I have highlighted are the unemployment rates at various points in time. So you see the 4.4, that's 4.4%. That's right before the beginning of the pandemic. And then you see it spiking to 14.8%. And then the most recent data, which I actually was able to update this morning, fell from last month from 5.9% to 5.4%. So a pretty steep decline in a 1 month period. And so we are back to basically levels that we were seeing somewhere around 2017 or so, or 2016. Peak employment in terms of the number of individuals with a job, or number of jobs anyway, hit 152.5 million February 2020, so right before the beginning of the pandemic. Employment is now, as of last month, 146.8 million. So we're down some 5.7 million jobs compared to the beginning of the pandemic, which I'll show you in the next slide. So this slide shows over the month job gains. So in each month, how many jobs were added or lost. And as always, at the very beginning of the pandemic, I mentioned this huge decline right after we see 20 there, these huge losses, the huge loss of jobs there, over 20 million month over month. And it makes everything prior to that look pretty comical, these kind of measly increases, although consistent increases over the span of a decade. Coming out of those losses at the beginning of 2020, we see obviously the bounce back that we have expected and seen. You see these gains of, I think, about 2.5 to 3 million jobs, and then nearly 5 million jobs, and then it's slowing. Since April 2020, so at the beginning of the recovery period, the economy has added an average of about 1.1 million jobs per month. That's a substantial gain in jobs in a month over month period. In 2021, so just looking at this year, so kind of subsetting the data and just looking at this year, including this morning and including the revisions to the last 2 months of data, the economy has added about just under 620,000 jobs per month. I mentioned that there were revisions to the last 2 months of data, and the last 2 months on net were pushed up over 100,000 jobs. And so If you recall, last month the number was something around 875,000, I think, jobs before the revision. A month prior, it was 500 and something. On net, those were pushed up about 100,000. 500,000 was pushed up to just under 600 or so thousand, and the 800 and something thousand was pushed up to low 900,000s, I believe. Nevertheless, the point is that I remember a couple months back when we got those data, especially that 500,000 or so jobs number, and it was actually a little bit disappointing because analysts were expecting closer to kind of 800, 900,000, maybe even 1 million jobs to be added. The upward revisions, I think, paint a little bit better picture in terms of what the economy was looking like and closer to analysts' expectations at that point. The participation rate and the employment to population ratio, these data came out this morning too, but I wasn't able to update them. What I can say is the participation rate is still sitting right around the levels that it's been sitting since right after the pandemic began. So it dipped down below 60.2. It increased to somewhere in the neighborhood of about 61.5, and it sat right around there ever since. This morning, the data came in at 61.7. In terms of the employment to population ratio, this actually did tick up fairly substantially. Unsurprising, it fell considerably at the very beginning of the pandemic, fell from 61.1% down to 51.3%, and it's back up to about 58.4%. So these numbers are obviously, these ratios are still quite low compared to historical standards, but there has been some upward movement, at least with the employment to population ratio over the last several months. Okay, let's see here. We can get going again. All right, so again, apologies for the delay, internet problems. It's actually shocking that it took this many forecasts for something like that to happen, but thank you for sticking with us. We definitely appreciate it. So without further ado, employment to population ratio I just covered. Onto unemployment rates. And I was curious, these data only extend through June, but I was curious, I wanted to look at if there was differences between some kind of ethnic categories or racial categories. And so these are data extending back from January 2019 through June 2021. You can see men and women, both white and black. The kind of reddish colored lines are white. The orangish colored lines are black. The hashed lines are women. And obviously you see that there is a disparity in terms of the rates depending on which race you're looking at. Generally white is lower here. You see during kind of the pandemic, these numbers started to kind of converge, get a lot closer, but they have again returned to a kind of a separation. They've started to separate again, sort of as the recovery started to begin. You can see that the rate for, and again, this is prior to the data that came out this morning. These have not yet been updated as far as I'm aware. We're looking at, closer to 10% for male blacks to 8.5% for female or to women, and below 6% for both men and women whites. So kind of was just curious to see, this is more for just, I was interested to see what these looked like, and I figured I would share them with you. Did the same thing for everybody and Hispanics. So you can see what these look like. The color coding is a little bit different here. Men is in red and women are in kind of this orangish color. The hashed lines are for Hispanic. Generally, the Hispanic unemployment rates are higher than for everybody on average. Another thing, as you all know, that we look at is real wages. As I had mentioned last forecast, the real wages and the wages should be the hashed line there in red, reference to the left axis. You see it sort of spike at the beginning of the pandemic. You see it kind of start to come down a little bit. The reason for that, as I mentioned the last time, is lower wage workers were first cut during the pandemic, meaning that the average wages increased. As those workers have returned, average wages have fallen. The growth rate, the blue line reference to the right axis, is the year-over-year growth rates. You can see that basically starting in this year, this calendar year, the growth rates have slowed, if not become negative. And so as you've gotten more of these lower wage workers back on board, that's pulled down the average. One thing that I think is interesting is when you go from the hourly earnings to the weekly earnings, we see that weekly earnings are continuing to stay elevated. And that really has to do with workers are, compared to a year ago, are working more. They're working more hours. And so we have, even though wages are starting to go down a little bit, and you see that actually trail off a bit in the last kind of the rightmost part of the chart here, but still, it's compared to the pandemic, average weekly earnings are elevated. So, and again, these are in real terms, so adjusted for inflation. Okay, so moving on to the US forecast piece. So as I mentioned at the start of the presentation, we have a national forecast that we get from IHS Markit. We use that as the input to our New Mexico forecast. And so as part of that, they provide us with some of the assumptions that they've included in their forecast, or kind of by extension, some of the things that are not included in their forecast. Many of these assumptions are similar to what they've had in the last couple of forecasts. So for example, for fiscal policy, they assume that all the stimulus that has been enacted so far has actually gone through. Of course, we know that that's the case. The important piece here, really, I think for our purposes, is that the forecast doesn't include any of the proposed infrastructure investment. And so, there's different numbers that have been put out there in terms of the dollar amounts for this. Obviously, it will have to work its way through Congress, if it does at all, and then be signed by the president. But they have not included any assumption that any of this infrastructure has actually will actually go through. Monetary policy, the big change here is that they have accelerated the rate at which the Fed starts to increase rates. I think in the last forecast, it was sometime in 2024. In this forecast, it's around mid-2023. Thereafter, it will tolerate inflation above 2% as a long-term average. And as long as the long-term average stays around that level, which is good because inflation right now is quite high, and that is something that is concerning some folks, the sort of spike in prices. The Fed expands balance sheets through late 2022. World GDP, growth of real trade-weighted foreign GDP contracted 4.8% in 2020. IHS now predicts that, or projects that, it will rebound 5.7% in 2021 and 4.8% in 2022. And then in terms of trade policy, it includes assumptions about the tariffs that have already been enacted and assumes that they will stay in place over the forecast. So comparing their last forecast in April to the current forecast in July, the current forecast is the bars. You can see that the federal deficit, very similar in both cases in terms of what they expect, slightly smaller this time in 2021 compared to last forecast, as the bar is a little bit above the line. As I mentioned, this forecast doesn't suppose or assume any additional rounds of fiscal stimulus, and it doesn't include any infrastructure. And so if it's the case that something gets put on the books this year, probably actually wouldn't even go into this year anyway. I suspect that it would go into next year. But nonetheless, very large kind of deficits in 2020 already in the books and expected in 2021. Oil and gas spot prices. West Texas Intermediate is in the left panel. Henry Hub is in the right panel. West Texas Intermediate elevated in their projection compared to last time, just under $70 a barrel in the kind of most recent quarters, or around $65 to $70 a barrel. Their expectation is for it to kind of to peter out a little bit over the next several quarters, and then start to slowly, very slowly increase basically from 2023 and out. Henry Hub, very similar to last time, although for those of you who have been looking at the data on the price per, it's actually spiked in the most recent couple of days that I've been looking at. So I suspect that this might actually be a little bit higher, end up being a little bit higher than their projections in the very near term. So compared to their April forecast, some kind of top line numbers in terms of how this forecast is different from last forecast. Employment growth came in at minus 5.7% in 2020. Their projection now is 2.8% in 2021 In April, they had it a little bit faster, 3.1%. And then some of that growth has moved to 2022, 3.7% versus 3.1%. And then averages about 0.8%, 2023 through 2026. You'll see in our forecast, based in part on softer data that's come in for New Mexico for the first several months of 2021, our projection for this year is softer, and then we have a little bit faster rates of expected growth in 2022 and actually going out into 2023 compared to our last forecast. GDP, as I mentioned, contracted 3.5% in 2020. 2021, they're anticipating a little bit faster growth, 6.6% versus 6.2%. Again, they were expecting 8% seasonally adjusted growth in the second quarter, and that came in quite a bit weaker. And so obviously, in order for us to get to 6.6% or to stay at 6.6%, their forecast for the second half of the year will have to be increased commensurately to push it up to that level. 2022, 5% versus 4.3%. And then over the remainder of the forecast, 2.1 versus 2.3 per year. Income growth, as we all know, 2020 had the very large transfers, 6.3% for the year, pushing total personal income up 6.3%, I should say. 2021, an additional round of stimulus, 6.9% versus in their last forecast, 5.6%. And then 2022 kind of getting paid back for pulling back those transfers, 0.9% versus 0.7%. 2023 through 2026, pretty much on level, about 4.5% in both cases. West Texas Intermediate came in at $39 a barrel in 2020. Again, for those of us who were paying attention to it as it was ongoing around April of last year, there was a day when price dipped down to $- per barrel, which is weird, but it did. For the rest of the year, the price was quite low, so pulled down that average to $39. 2021, their expectation, $65 a barrel. We've been running above that pretty consistently throughout this year so far, or for at least the last several months of this year. As I mentioned at the beginning of the forecast, this morning we were about $68, $69 a barrel. I don't know whether that shifted in the last couple hours. And then averages about $63 a barrel in 2022 through 2026. Prices increased about 1.2% in 2020. This is CPI. Their projection now is for 2021 to increase by 3.7%. So a sharp increase due to higher input prices, higher energy prices and the like, versus their expectation last time, 2.4%, and then 2.4% in 2022 versus 1.5% the last time. So an elevated expectation for prices in this forecast. And then a stronger projection in terms of housing, given the housing market, the strength of the housing market, and the need for new housing. Starts have been pushed up a bit. So jumps next year to 1.573 million, averages 1.343 million thereafter. So this is a little bit of an increase compared to last forecast. Okay, so some quarterly comparisons of GDP. So the numbers that I've highlighted there, that 8%, that was IHS's projection for the second quarter of this year. And again, as I mentioned, 6.5% is the number that it came in at. 8% was what they had targeted even in April, or something around 8%. Their expectation for the remainder of the year is elevated, continuing to be elevated, 7.6 and 8.2% respectively for the last two quarters. What I can say is that they release these updates to their projections for GDP. I believe that the second half of the year has been brought down a little bit. So my expectation would be when they come out with a new forecast, that their expectation for GDP will be brought down a little bit, probably more consistent with what they were expecting for the year anyway in April. Employment forecast comparison, you can see the 4 quarters right after the pandemic began, and these are year over year. You can see the 4 quarters being brought down, so kind of this job loss in each quarter, and then adding back jobs basically starting in the second quarter of this year, kind of in a year over year basis, and then adding jobs throughout. I won't spend too much time here because I'm going to talk about the individual sectors in a moment. Unemployment comparison, this isn't terribly dissimilar from what we were seeing in April, slightly higher, mostly because their expectation is that more folks will join the labor force given the reasonably stronger employment outlooks and the like, but not substantially different from what they were expecting in April and not substantially different from what they were expecting in January. By sector, we can see in 2020, every sector here in the red. So lost jobs, we can see leisure and hospitality lost over 3.2 million jobs, trade, transportation, and utilities. So this includes obviously utilities, but it also includes retail trade and wholesale trade. The big thing here really is retail trade in terms of raw numbers, down 1.1 million jobs. Professional and business services lost over 1 million jobs, and kind of all other private industries about 1 million jobs. Government lost about 700,000 jobs. And that's in spite of the adding of the federal workers for the decennial census program. This is a loss of jobs in state and local government, really. And then the bottom line, about 8.7 million jobs lost sort of on average for the year, down 5.7%. Moving forward for their projection, kind of bouncing back the sectors most immediately, leisure and hospitality, really because it lost so many jobs for the year. 1.3 million is their expectation, and professional and business services, 700,000 jobs or so. Trade, transportation, and utilities really bouncing back. Retail, surprisingly, 890,000 jobs. But then you see for the remainder of that forecast window, really shedding jobs as folks go back to, big box retailing and purchasing stuff online. For the longer period, the sector that we really expect to do well, or the sectors that should add a substantial number of jobs anyway, leisure and hospitality as it continues to dig itself out of a hole, and also professional and business services, 700,000 jobs in 2021, almost 1.5 million in 2022, 750,000 or so in 2023, and then kind of slowing down thereafter. But those are the sectors really expected to add a substantial number of jobs. Surprisingly, in this forecast for IHS, healthcare doesn't do particularly well. Lost about 600,000 jobs in 2020, but only about 250,000, 225, 250,000 in 2021, 2022, flat in 2023, then less than 300,000 in 2024. By the end of the forecast, we end up above where we were prior to the pandemic, but still nowhere near where, a couple of years back, we expected this sector to be, I don't think. So on the very bottom line, you can see the annual rates of growth. As I mentioned, contraction of 5.7% in 2020, expansion of 2.8% in 2021, 3.7% in 2022, slows to 1.7, and then slows to less than 1% per year thereafter. Interest rates, as I mentioned, mid-2023 is when the federal funds rate is expected to start to increase. So it pushes forward the timing of that. Obviously, it's not expected to go up a ton right out of the gate, but still, it's a change in terms of the timing. You see conventional mortgages and 30-year bonds increasing much more quickly, or soon, I should say, than the other rates. And then thereafter, they will kind of follow this increase in the federal funds rate, and obviously T-bills as well. Personal income forecast comparison. So I have highlighted there the most recent stimulus. This is growth in personal income sort of year over year. So in the first quarter, expanded nationally about 16.6%. You see year over year kind of gains just because these levels are very high. And then you see a year later getting paid back, contracting 5.5% as that stimulus, that transfer stimulus is reined in or pulled back. And then you see very slow rates of growth until basically end 2022, early 2023, when the levels, or I should say the year-over-year growth rates anyway, average something around 4.5% to 5%. Real disposable income, so kind of taking into consideration what people actually really have to spend, you see these huge increases for this two stimuli, the two periods, and then you see basically more than a year of kind of getting pulled back in terms of real disposable income. Fairly consistent with the April forecast. And as I mentioned, housing starts were revised up in this particular forecast compared to last forecast. It's the second consecutive quarter of revision. Prior to last quarter, and actually sort of pre-pandemic, I could have gone several years and this would have looked exactly the same every time. And although the trend generally looks the same, seeing it increase a couple quarters in a row is definitely different than what we've seen in the past. So increased expectations in terms of what this particular market looks like. And then what the alternative scenarios look like. As we know, IHS produce a baseline scenario. That's what I've talked about so far. They also produce a pessimistic scenario and an optimistic scenario. In this particular forecast, compared to April anyway, they've increased the probability, the optimistic scenario, from 25% to 30%, and reduced the probability of the pessimistic scenario from 25% to 20%. And so I'll talk about this a little bit more when I get to the New Mexico section. And I can discuss very briefly what some of the assumptions are underlining each of these scenarios. Okay, so moving on to the New Mexico portion. So the New Mexico current economic situation, and by the way, you'll see many of these things that I have on the slide, at least the text parts, are similar, generally similar to our expectations last forecast. The difference is really that the near-term data is a little bit weaker than expected. Some of the employment data came in a little bit weaker to end the year, so the fourth quarter QCW data, and some of the CES data, the survey-based data for the first part of the year is a little bit weaker than expected. So we have adjusted our expectations down for 2021 and had kind of a little bit more of a bounce back in 2022 and 2023. And as I'll mention at some point during the presentation, this forecast is revised down by the end of the forecast period a little bit, not a lot, but just a little bit. It's the timing that's shifted a bit, kind of pushed out basically a year compared to last forecast. So COVID-19 obviously is still a concern. Vaccines, as we know, are rolling out. New Mexico is doing better than most states. I'll have the slide that I've showed the last couple quarters here in a minute that shows what New Mexico looks like compared to other states. Unemployment insurance claims and really the continuing claims are falling. The initial claims over the last couple of weeks have increased, but the continuing claims generally have a downward trajectory. New Mexico is still performing worse than most states, and I'll show you slides on that in a moment. As I just mentioned, fourth quarter QCW data is now available. As we talked about the last couple quarters, in the second quarter, leisure and hospitality and other services lost about half of all of private sector jobs in the quarter. Retail trade and wholesale trade lost about 14% of all of the jobs lost in that quarter as well. The other sector that lost a ton of jobs, in addition to mining, as we all know, the other sector is local government, as tribal businesses contracted in the quarter, and tribal businesses are kind of shoehorned into local government. In the third quarter, 3/4 of the private sector jobs that were actually added back, kind of on a quarter-over-quarter basis, came from those sectors, not the local government, excluding local government, but the other ones that I mentioned. But gains are generally slow. And in the fourth quarter, there were quarter-over-quarter gains, but year-over-year jobs were, of course, lost. Oil has firmed in terms of price. Price is around $70 a barrel, and drilling is robust and production is high. And as I mentioned the last time, and again, we all know this as well, softening in production or price will obviously impact the state budget. Okay, so as I've shown, I think the last couple of quarters, this is just a screenshot from the New York Times pulling data from the CDC. We can see on the left panel there in January 2021, New Mexico was one of the top states in terms of getting at least one shot to folks, and also, and actually even in terms of getting 2 shots. In the most recent data that I pulled, this I'm sure has been updated in the last week or so that I put the slide together. New Mexico was still one of the top states, although the rate at which folks are getting vaccinated seems to have slowed as we are kind of moving down the list here. We're still, again, one of the top states in terms of being fully vaccinated. And so there's that. That's I think, good news. Good news in the sense that it makes it more likely that, or I should say less likely that there will have to be kind of restrictions put in place going forward that may hamper business investment and growth. And also the kind of the second side of that coin, which is hopefully gives people confidence that it's relatively safer to get out there and actually engage in some of the economic activity that they were engaging in prior to the pandemic. Unemployment insurance claims by state. So these data just include the standard unemployment insurance claims, and these are the continuing claims. And I've shown these the last several quarters. But the point here, and I'll kind of just, without dealing with the actual numbers, because the numbers just, I think, help bolster the point. But the point here is New Mexico wasn't hit as bad as other states at the very beginning of the pandemic, but it's been very slow to recover compared to other states. So at the peak of the pandemic, and these data are monthly. I think in the past we had done kind of weekly, but just kind of to aggregate it to the months. At the peak month, May 2021, 12% of all UI eligible New Mexicans were on UI. So that's basically right in the middle of the pack. Since May, UI rolls have declined by about 85,000, or about 90% of peak enrollment. Only 12 states have kind of done better in proportion. Obviously we have lower numbers of people. We're a small state, so we don't have as many people working. So hence we don't have as many people kind of eligible for UI or who are not working. And we have relatively, even though it seems like we have a lot of people coming back, in percentage terms, only about 12% of states are kind of doing better, or 12 states, I should say. Looking at sort of a broader description of unemployment insurance, this includes unemployment. It includes all of the kind of the programs that proprietors or contract workers might be eligible for, as well as extended benefits. You'll see, and these data are the most recent data available. I think we got them at the end of last week. You'll see initial claims on the right. They've had an uptick since kind of basically May. And then you see the continued claims kind of declining since July of last year. So the trend has been generally downward over the last several months for the continuing claims. So there's that. Obviously, the initial claims, perhaps that's a cause for concern that they're increasing, but the fact that the continuing claims are declining suggests that people are leaving faster than they are joining. So I think that's kind of offsetting in terms of the thinking there. This slide shows year-over-year change of labor force. So these are levels by various regions of the state. So the various MSAs, also Lee and Eddy County, kind of that 2-county region, and the rest of New Mexico. You can see sort of at the beginning of the pandemic, the declines in the number of folks in the labor force according to these data. And then you can see basically a year later, an addition of folks as they rejoin the labor force. What I'll say, of course, as I say sort of every time, these data are subject to revision. They do get revised, and it takes quite a while for us to see the revisions be somewhat minor. And so it might be the case that the number of people leaving the labor force gets revised in a way that it pushes things up, or it's relatively worse, or the number of people coming back in the recent months is relatively lower. But I think that the broader point here is, of course, we saw huge losses at the beginning of the pandemic and through the middle and end term of the pandemic. And then a year later, we actually do see people returning to the labor force. So comparing New Mexico to all the other states, these are the CES, the survey-based data, employment data that I was mentioning. And what I'm doing is I'm indexing the employment levels for all the states back to January 2020, so a couple months before the pandemic started, just to see what percentage of employment we got back, or each of the states have gotten back. You can see the red line, which is New Mexico, didn't dip as low as many of the other states. So New Mexico lost a smaller percentage of jobs that it had in January 2020, but has been very slow, as I mentioned a couple times, to recover. 48 states have recovered at a greater share of jobs than New Mexico. The only states that are worse are Alaska, Hawaii, Louisiana, and New York. In terms of jobs numbers, Idaho and Utah have fully recovered. It's similar to the last slide. These data are survey-based, they are adjusted, they are revised. And so it could be the case that, for example, the states like Idaho and Utah, especially since they're relatively low population states, they tend to be most subject to revision, just like New Mexico. They may not have completely recovered, although the data at the moment suggests that they have. My guess is that they are probably doing pretty good anyway, but maybe not quite as good as expected here. But when these data are benchmarked back to the QCW, we'll have a better idea. Increased New Mexico field oil production presence. Currently, there's about 75 drilling rigs operating in New Mexico. I looked for the most recent data that I could find. I think there was actually 74 rigs in operation. About 15 to 20% of all US drilling rigs are drilling in New Mexico. So obviously New Mexico, in terms of its drilling activity, is sort of punching above its weight. More than 10% of all US field oil production is occurring in New Mexico, and that's up from about 4% in 2016. And then I have some data there just to help put these numbers in perspective in terms of the number of barrels actually being produced per day. New Mexico accounts for around 5% of all US gas production by volume. So whereas New Mexico is really kind of pushing ahead in terms of its oil drilling and extraction, gas production is sort of, hasn't moved as much, I should say. One of the things that seems to be the case is that the producers are moving to more efficient, kind of in quotes, production techniques. And efficient here means they're able to produce more oil with fewer workers. So you can see that New Mexico mining, kind of in quotes, jobs averaged about 20,000 in 2016, peaked to about 26,000 in 2019, and now, as of the most recent data that I've seen, sitting about 17,000. Obviously, there are reasonable labor demands for drilling, but production is deviating. Again, that is to say, even with these reduced number of workers, we're still producing more oil. So the amount produced per worker is very high. Fewer workers. So for local areas, if you're in kind of the southeast part of the state in particular, in Lee or Eddy County, fewer workers you have in that area that are working in these fields to spend in the local economy. Obviously, there are negative impacts to associated industries. So other industries that have high association to mining in these areas include construction, it includes wholesale trade, it includes transportation and warehousing. So these other sectors kind of almost directly impacted. And then of course, there's other sectors that are more indirectly impacted that provide support to those sectors. So things like accommodation and food services or other other services that would provide services to the people in that area. So as they've sort of migrated out or stopped working, or those jobs are not available, obviously there's less stimulus in that economy in kind of that part of the state to prop things up. Obviously, from the state's perspective, the fact that production is very high and that oil prices has firmed, that kind of puts a floor, so to speak, underneath their kind of tax revenue. So from the state's point of view, fiscally, things are going sort of okay. Of course, they're going to be losing some of that personal income tax and all of that, but really the royalty payments and the like are sort of much better now that production is high and price has increased. Okay, so comparing other, sort of switching gears here, comparing various parts of the state in terms of housing. So these are housing sales. These data are from the New Mexico Realtors Association. You can see the various parts of the state. So Albuquerque, Farmington, Las Cruces, Santa Fe, Lee and Eddy, and sort of the rest of the state. So New Mexico minus those places, both in terms of number of sales and comparing 2020 and 2021, and also in terms of the median sales price. So sales in most places have increased. The sales in Las Cruces, according to the data that they have there, are very low. I'm still not sure why that is. I sort of suspect that it's an error, but that's the data from the most recent reports that I've seen. Year to date, statewide, sales are up 13%, and median price is up 18% statewide, from 225,000 to 265,000. So we're seeing increased sales and we're seeing increased price still. It will be interesting to see what happens going forward. But obviously we've seen kind of this, what almost looks like it could be bubble territory. And I know that folks are concerned within kind of the banking industry and within the housing industry. Switching gears again, these show taxable GRT, and it's looking at the first quarter of 2021 compared to the first quarter of 2022. The left panel is looking at dollars, kind of in millions of dollars. Anything kind of to the left, the white bars are in negative territory. The right panel is looking at percentage growth over the kind of year-over-year growth. Bernalillo County is huge and saw positive growth. So, you know, that's where a lot of the kind of positive movement was in taxable GRT in the first quarter. But you see these huge contractions in Lee and Eddy County, basically, you know, pulling back in terms of the people working in the mining industry, pulling back the GRT and people spending money, et cetera, in that part of the state. You can see this is sort of organized by the dollar amount. So Bernalillo, kind of the rest of the state that's not included in the named areas here in terms of levels, Sandoval County, Santa Fe, Torrance, Valencia. So many of the top ones here obviously are related to the Albuquerque MSA or the Santa Fe MSA. Okay, so moving forward to the next slide, basically showing the same thing in terms of what's on the left and what's on the right, except for now we're looking at by sector. So taxable GRT, first quarter of this year over second quarter, excuse me, over first quarter of last year. It should be first quarter of last year. The sectors that have added most of the bottom line, retail trade, healthcare, and to a lesser degree, the other things listed that are in the blue. The things really pulling stuff down, mining and information, as we've seen really some of the industries in this sector, filming and the like, contracting over because of really the pandemic, filming activity slowing, and the purchases made in that industry being reduced, at least in kind of the span post-pandemic, pulling things down. Okay, so state recurring revenue. So this is June 2020 through March 2021. These data are from the LFC. Oh, the last data was from TRD. So their gross receipts data. So from the LFC, their revenue report, just to kind of walk through this real quick. So over the first 3 quarters of the fiscal year 2021, GRT pulled things down, reduction of about 154 million. Also rents and royalties, so especially things related to the oil and gas industry, down 180 or so million. Those were really the big ones. We saw increases in personal income collections and corporate income tax, even mineral production taxes. But these are kind of the recurring revenues, and on net, obviously things are down for the fiscal year 2021 through March. Okay, so moving on to the outlook portion. So taking all of that information in terms of the historical data and taking in the information from IHS in terms of their projections and kind of running that through our model and making adjustments based on sort of what we know about New Mexico, this is kind of where we've landed. So the forecast now is somewhat less dependent on COVID-19 trajectory and more on business and behavioral responses in New Mexico. What I'll say to that is because of the uptick in the number of cases, the number of hospitalizations, at least nationwide and the like, we say that it's less dependent on the COVID-19 trajectory, but I think that the rapid increase over the last, several or at least week or two makes me a little bit more cautious about that point. If you look at IHS in terms of their projections, their baseline scenario kind of assumes that things generally go swimmingly, and that is what our baseline scenario is generally based on too. Their pessimistic scenario, on the other hand, assumes that there is a rise of a variant or a set of variants, that the number of cases increases, that we don't get to herd immunity, and things are a little bit harder to control moving forward. And to me, that appears, at least at the moment, more of what we're looking at. That said, I'm not sure that even their pessimistic scenario fully incorporates all of those elements. I would say that our additional pessimistic scenario that we produce, our kind of so-called pessimistic 2 scenario, better captures what that outlook might look like. So we produce for New Mexico, obviously the baseline scenario, we produce an optimistic scenario and a pessimistic, kind of a pessimistic 1 scenario, but we also have this kind of second pessimistic 2 scenario that I'll touch on when I get there. So there was a loss of about 89,000 jobs, nearly 90,000 jobs in the second quarter, and this is quarter over previous quarter, before recovering about 13,000 jobs in the third quarter and about 15,000 jobs in the fourth quarter. This is quarter over quarter. These are QCW data that are not seasonally adjusted. So looking at things quarter over quarter is less than perfect. If you look at things on a year over year basis, you'll see contraction in the third quarter and the fourth quarter. It's just the level of those contractions are much lower than the year over year contraction in the second quarter. For the year, for 2020, the economy averaged down about 55,000 jobs compared to 2019. In this forecast, we're projecting that the economy is going to grow less than 1% in 2021 and then gain steam in 2022 about 2.8%. If you recall, looking at the IHS projections, 2022 was kind of the peak in terms of the rate of growth. We're not anticipating rates of growth that IHS is for the US, slower, but definitely faster than our previous forecasts for 2022. And then growth is projected of about 1.5% per year thereafter, with the bulk of that growth kind of in the nearer term, 2023 really. Economy ends at 2019 levels in terms of employment by 2024, basically on level with the level seen in 2019, just marginally above. This is the same as last forecast, although we are just a little bit lower this time. By 2026, employment some about 25,000 jobs above 2019 levels. I think we were about 30,000 jobs by the end of the forecast in the last forecast. As I've talked about, income patterns are slightly different. Strong growth in 2020 and 2021, some weakening in 2022 because that transfer growth will be pulled back, and then accelerating slowly thereafter, about 4.7% per year. Obviously, there's some optimism as things start to open up, but as I mentioned, the variants could dash hopes. The rate or the increase at which people are contracting the virus, or if hospitalizations go above a certain threshold, that is obviously concerning. Although slow growth after the recession, this is what I said in the last quarter, it does seem to be that New Mexico is in better shape this time compared to the Great Recession. After the Great Recession, it basically took the state a decade to get back to levels in terms of employment that we were seeing prior to the Great Recession. But there is actually some news that there are businesses looking to invest in New Mexico, or that already have and looking to expand. So that's good news in terms of the economic kind of trajectory or expected trajectory going forward. One thing kind of pulling things down, and actually it's apropos that we have our guest speaker today maybe can touch on this. Businesses are reporting having difficulty finding workers. Obviously, as we've seen in the news, there are some things that businesses are trying to do to attract workers, whether it's bonuses or getting paid on their first day or the like. There are things that businesses are trying to do to attract folks. The question, of course, is what's driving this and how long will it last? And we don't know, but hopefully that is a trend that we can see turn around moving forward. Okay, so in 2020, I've put the sectors here in terms of, obviously it's read down by kind of NAICS, so NAICS 11, 21, et cetera, for not all of them, for most industries. You can see the sectors really kind of doing poorly in 2020, the ones that lost the greatest number of jobs. Accommodation and food services, more than 17,000 jobs sort of on average for the year. Mining pulled things down about 6,000 jobs. And so whereas accommodation and food services is a large industry in terms of the number of folks working in it, you have mining, which lost obviously a smaller number of jobs, but lost about the same percentage of the workforce in 2020. And again, much of this is concentrated in really the southeast part of the state. You also see retail, trade, information, admin, healthcare, and arts all contract for the year. And as I talked about a little while ago, local government, partially because of things going on at the municipal levels or local government, directly local government or county government, municipal government type levels, maybe not refilling jobs or the like. You're also seeing contraction because of closure or temporary closures of operations at tribal businesses. So once those get more up and running, and I know that they were supposed to kind of at the beginning of July, the hope is that some of this will start to right itself moving forward. Compared to our April forecasts, our employment growth projections, so our most recent forecast for July is the bars. The line is our April forecast. In this forecast, we've pulled things down in the very near term and then pushed things up in the longer term, or excuse me, the middle term. And then the forecast is similar throughout for the remainder of the period. In terms of the various sectors that we're expecting to kind of push things ahead, at least over the 4-quarter period right after the pandemic. So as I mentioned, nearly 90,000 jobs last in the second quarter. Over the period from 2020 quarter 3 through 2021 quarter 2. So this of course includes data that we have in the books for the third quarter and fourth quarter of last year, and our projections for the first and second quarter. Really the sectors that lost the most jobs, like accommodations, even healthcare and retail, they're the ones that are going to bounce back the most over that period, or that at least started to bounce back. Other sectors we expect to still contract include mining and government. Compared to April, this is downgraded by about 7,000 jobs. We're expecting over that 4-quarter period a gain of about 36,000 jobs, which is about 40% or so of the jobs that had been lost just in that second quarter. Moving on to the forecast by industry, 2021 through 2026. Accommodation and food services, again, a large sector, leads the way. Also, healthcare and social assistance, adding almost 10,000 jobs over the period. An area for opportunity, as we talk about pretty much every quarter, professional and technical services. That's the industry that IHS has expected to do very well over the last several forecasts, and projecting it to do well really over the period 2022 through 2026. And for New Mexico, that is an area of opportunity that we've identified. We've been strong in historically. It was weak after the Great Recession, as basically every industry was, but the years leading up to the pandemic, it really had strengthened and kind of come into its own. Also construction, about 5,000 jobs. The right panel that shows the growth, so total growth over the period. You can see some of the smaller industries that don't add tons of jobs like arts and recreation, the growth rate quite high because there's not that many jobs there. Mining kind of rights the ship over the period. And this is a change from our previous forecasts. We're actually anticipating some addition in the mining industry in terms of jobs, but it will not get back to where it was prior to the pandemic by the end of the forecast. So changes in terms of the personal income forecast. This isn't much different from last forecast. You can see the 17.9%. That's the most recent stimulus and how it played out in New Mexico. Very rapid rates of growth. You see things slowing on a year-over-year basis until things go negative a year later and then stay essentially negative for the remainder of the year or flat. Basically, starting in 2023, we're seeing or expecting income growth to average something in the neighborhood of about 4.5 to 5% per year, or even on a year-over-year basis, I should say. So I think this slide illustrates probably best what it means to have gained that those transfers in 2020 and 2021. So federal transfers to individuals, so the stimulus payments, the unemployment benefits, and the like. You see the bars represent the amount or the growth added to income. So the kind of orangish color, that's transfer payments. You see those really large positive bars in 2020 and 2021. They more than compensate for the loss of private wage and salary disbursements. So as of course the economy contracted in 2020, fewer people working, private wage and salaries contracted in 2020. You see transfers, again, more than making up for that. In 2021, with modest wage and salary disbursements, you see transfer payments again making up the difference. And then you see that being pulled back in 2022, such that they're pulled back so much we end up in total personal income with negative growth for the year. So while wage and salary disbursements kind of get back to a more typical level or typical trend, transfer payments are really pulling things back. And then 2023 and out, we start seeing, again, as I mentioned, a growth of somewhere in the neighborhood of 4.5 to 4.7% per year. Okay, so moving on to some alternative scenarios. So in this forecast, as has been the case in the last couple of forecasts, the uncertainty is, of course, unprecedented. We don't only have to contend with the normal variation in the economy, the normal uncertainty there. We have to deal with uncertainty with respect to getting the virus under control. And so there is, or should be, a pretty wide range of outcomes. When we run the IHS scenarios through our forecast, we don't really see that wide range, which is, again, why we have this sort of pessimistic 2 scenario. The pessimistic scenarios, of course, consider the challenges facing the state, including access to federal loans or trend towards consolidation, perhaps some government budget cuts. Pessimistic 2 scenario, it's more of an L shape with an incomplete recovery by the end of the forecast, which we will see. So for kind of reference, this is IHS and their projections for GDP. And so the left side, this is real dollars, so billions of real dollars. On the right side, it's growth. And you can see, obviously, the optimistic scenario does better than the baseline scenario, and the pessimistic scenario does kind of marginally worse. You see in 2021 Q2, where we kind of achieved the level of GDP. So in terms of kind of real dollars, we're back to pre-pandemic levels. But obviously things diverge from there. In terms of growth, GDP growth, we can see on the right slide those same things. You see the trajectory for the optimistic scenario, much more robust in the near term, pessimistic scenario, a little bit weaker, and then they all sort of converge in terms of the rates of growth from really early 2022 and out. Obviously, what we're kind of concerned with here is, what does this do to the employment scenarios? So this again is IHS, and this should be for July, not April, but this is the newest data that they have for July. The black line really here is what does the jobs level look like under the baseline scenario? That's the solid line, the black one. The optimistic scenario is what do the jobs levels look like under their optimistic scenario, and what do they look like under the pessimistic scenario? And really what we have here is, when do we get back to the levels that we saw prior to the pandemic? The optimistic scenario, we get back 2022 Q2, the baseline scenario 2022 Q3, and the pessimistic scenario 2023 Q1. For New Mexico, things are delayed compared to that. We don't see or aren't anticipating the rates of growth that IHS is in terms of employment. So again, how does this play out for New Mexico? We have 4 scenarios instead of 3. We have an optimistic, a baseline, a pessimistic. Those are all run through using the IHS kind of projections, and our pessimistic 2 scenario, which takes into account a trajectory that we sort of anticipate for New Mexico in a more worst case scenario. What you'll see here is that really New Mexico's optimistic and baseline scenarios are only very minorly different. We end up back to employment levels that we saw prior to the pandemic in 2019, in 2024, and it's really kind of 2025 under the pessimistic scenario that we end up at levels that we had prior to the pandemic. Obviously, the near-term rates of growth are slightly slower in the pessimistic than the baseline and optimistic, but generally overall, the projections are pretty similar in each case. We felt, as I've mentioned a couple of times, that this doesn't really capture the level of uncertainty related to the impact of the virus or these variants might have if there are additional closures imposed, or kind of a worst case scenario. So that's what that last kind of pessimistic 2 scenario is. In the pessimistic 2 scenario, actually, if you go and look at the data on a quarterly basis that we send out, what you'll see is a very brief kind of double dip recession. I don't think that we've actually seen this before. That's kind of the way that it was modeled through this time. What that ends up kind of causing is we end up with continued employment contractions in 2021. And again, I think this is a lower kind of worst case scenario. Even if it's the case, I would suspect that that COVID is relatively harder to manage than was expected, a couple months back. I think it's harder for me to wrap my brain around the idea that we will end up in a situation where we continue to lose jobs in 2021. Although I think that this is a useful case to consider. The other thing I'll point out is that some of the most recent CES survey-based employment data for I can't remember what month it is, but for the last couple months of the most recent quarter that we have, what we're seeing is year-over-year growth in that data. Again, these might be revised and changed moving forward, but the positive rates of year-over-year growth suggest that perhaps this is a little bit draconian in terms of its outlook. So moving on throughout the rest of the period, what we're seeing are rates of growth that are generally similar to the rates of growth that we would see under the baseline or pessimistic scenarios, but the pessimistic 2 scenario never really closes the gap, such that by the end of the forecast window in 2026, we don't end up back to levels that we saw prior to the pandemic. And that would be more consistent with our experience that we saw in the Great Recession, or kind of coming out of the Great Recession. And then just kind of to show you the various scenarios and how they play out for income: optimistic, baseline, pessimistic, and pessimistic 2. These are nominal dollars. And this is exaggerated because the scaling starts at 90 rather than 0, but just to kind of show you that the scenarios sort of fan out depending on the particular situation. So in the optimistic scenario, you have really what happens is you have sort of higher paying jobs and higher wage growth. You have better kind of investment income and the like. In the best pessimistic scenario, you have what's added are relatively fewer jobs, and the jobs that are added are relatively lower wage jobs, and sort of worse outcomes, expected outcomes for the various other components of income that are keeping things relatively low. The pessimistic 2 scenario, of course, it's sort of worse on every front. Okay, let me check my time here. So very quickly, I will go through the MSAs. Of course, you have all of this data, and you'll have the presentation as well. So the various areas of the state: Albuquerque, these are the year-over-year job gains or losses going back to 2018. So Albuquerque lost about 41,000 jobs at the beginning of the pandemic, year over year, and then about 29,000 jobs, and then about 28,000 jobs. So basically contracting by less as you move through the year. Las Cruces lost about 6,000 jobs at the beginning of the pandemic, and then about 4,300 or 4,400 jobs in the third and fourth quarters. Santa Fe improved where it was in the second quarter, but still lost a substantial number of jobs in the third and fourth quarters. And there are relatively fewer people in the QCW data in Santa Fe than, for example, Las Cruces, which is generally sort of similarly sized economies, but were impacted more heavily at the beginning of the pandemic because their economy is so heavily reliant on sort of the service industries, accommodation and food services, other services, and the like. Lee and Eddy County kind of bucking the general trend of other places. And what we're seeing there is lost about 7,000 or so jobs in the second quarter year over year, then lost about 13,000 jobs in the third quarter, then nearly 14,000 jobs in the fourth quarter. So their situation got kind of worse throughout the year as really the mining industry and the other related industries contracted more as the year went on. And then Farmington and rest of New Mexico, we can see the trend there is the real big hit in the second quarter, and then the kind of slowing of the losses for the remainder of the year. Just to put these in perspective, really for rest of New Mexico is, if you were just to categorize areas of the state that I've talked about, so the MSAs, Lee and Eddy County, and rest of New Mexico. Rest of New Mexico, in terms of just raw numbers, would be the second largest in terms of the number of people working in that industry. And so 16,000 job loss, 17,000 job loss is obviously a huge number, but in percentage terms, it's not that large. It's not out of sync, I should say, with some of the other geographies of the state. Okay, going through the individual places very quickly, we can see in 2020, accommodation and food services in Albuquerque really was the big loser here in terms of the number of jobs lost. Local government, we have a bunch of tribal businesses that contracted as operations ceased for much of the year, or were sort of skeleton crews for much of the year. Admin, waste, and retail trade. Arts and recreation, again, a very small sector, but contracted fairly heavily in the year. Our projection for 2021 through 2026, the large sectors, accommodation and food services and healthcare, really adding the greatest number of jobs. Local government bouncing back from the losses in 2020 and early 2021, adding a substantial number of jobs over the period. And construction and professional and technical services, where Albuquerque has sort of an advantage there, we are expecting to move ahead. Las Cruces, accommodation and food services, admin, retail trade, local government, very similar story to what we were talking about in Albuquerque. In terms of 2021 through 2026, we're actually expecting accommodation and healthcare to be the biggest kind of gainers coming out of the pandemic. Other sectors, transportation and warehousing, which didn't even contract in 2020, we're expecting to continue to add jobs, which probably makes sense given where they are. Construction, adding jobs, and professional and technical services as well. One thing just to kind of be mindful of is the scaling on the left and the right is a little bit different. So the huge losses on the left require the scaling, and this is the case for all of these charts, require us to go to negative 1,500. And the right, we're only going up to 1,200. So just kind of keep that in mind when looking at these numbers. Although the bars themselves may look larger, on the right, it might not be the case that we're adding as many jobs as were lost over the period. And this is particularly true in a place like Santa Fe. So for example, you see accommodation and food services lose about 2,900 jobs in 2020. And then over the period from 2021 through 2025, adding about 1,300 jobs. And so not gaining back all of the jobs that were lost. So again, the scaling here is important to note. Healthcare lost jobs in 2020, as did retail trade. Over the longer period, we're expecting healthcare to do quite well, arts and recreation to do well, construction to also add a substantial number of jobs. Lee and Eddy County, mining is really what kind of dragged things down. But as I mentioned, other industries that are sort of directly related to mining, so things like construction, transportation, and warehousing, also saw contraction. Accommodation and food services that provide support to those folks in terms of hotels, restaurants, and the like, also contracted. In a departure from what we've seen in previous forecasts, we're actually anticipating that some of these jobs in mining will actually be gained back, and that will help to stimulate the economy in other ways. So, of course, construction and accommodation and transportation and warehousing will all see some growth over the period. So in this particular forecast, Lee and Eddy was actually pushed up a bit compared to our April forecast. And then finally, Farmington. Mining, construction, accommodation and food services, and local government all taking a hit in 2020, 2021 through 2026. Many of those industries that I've mentioned kind of gaining back some of those jobs, mining again, construction, and local government adding jobs over the period. And so again, you have all of you will have all these slides, and you have all of these data in the Excel spreadsheet that Rayanne sent out for us. And with that, our next forecast will be Friday, November the 5th, if I'm not mistaken. And so if anybody has any questions, I would be happy to answer them.
Everyone's so quiet today. Oh, here we go. Why is there a divergence in the employment and and wage and salary disbursement outlook between 2021 Q1 and Q2. Employment is going up, yet total wages and salaries are seeing a dip.
Let me see. And just quarter, is that in the data? I mean, so I guess I don't know exactly. I'd have to go and look at the data and see why it was. My guess is that so wait, 2021 quarter one. So in that particular quarter, I know that employment we're projecting to contract year over year. I don't know what wages look like, other than to say those data are actually in the books. So the first quarter of 2021, if that's your question, the first quarter of 2021 comes from BEA, and those data are actually out. And our projection for the first quarter in terms of employment are down. And so I would actually have to look to see why that is. I'm not entirely sure. My guess is that it's relatively lower wage jobs are added. And, you know, there's some, it might be that, you know, I'd have to actually look. I think that the lower wage story is definitely part of it, but I don't know without looking at the data.
Anyone else?
All this talk of virus and variants has gotten everybody bummed, I think.
I think so. All right. Well, if anyone comes up with a question, you know, feel free to drop it in the chat. Mo's not going anywhere, or send us an email and we'll get back to you.